Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Another way that we've been trading ETFs, again, I said we've been trading weeklies, but we've been looking at intraday price action with intraday trend lines and had a lot of success with it recently. If you look, here's SLV. And again, this chart was a couple days ago. We know it sold off today. Nonetheless, the blue arrow is when we actually traded some calls. And at the time, you could say, SLV's had a big run from, about 26 to 36 approximately. Very overextended in the near term. But at the time, its Schaefer's volatility scorecard was up in the 90s. So again, it said, yeah, it's had a big move, but the option still might not be priced correctly. So what we did was we looked at the intraday price action here. And I know that, we like to use 30-minute charts on these ETFs that we trade. And we found you can just kind of do whatever is most comfortable for you. But the 80 unit, which is the blue line right in the middle of the chart, is kind of when that SLV was in a consolidation pattern there. Went to that 80 unit, and we actually, like I said, we bought some calls there. And fortunately, silver had a really nice run for about 2 weeks, really, after that trade, and it continued to go higher. Now, interestingly, as we said, SLV sold off a lot today. It pulled back, actually, right back to this 80 unit on a 30-minute intraday chart. And this trend line has been a really nice buying opportunity on silver for several weeks now. So we're contemplating, we didn't do any trades today, but we're contemplating if silver was to bounce some tomorrow. Even though silver pulled back, we still think that it's in the overall uptrend. It could be a nice potential play for another move higher here. Now, the ISE submits some of these weekly options. And looking at the ones that they submit for potential trades, Ford stood out. That Ford just had earnings, but Ford has an 83 volatility score. So there's a lot of potential for some activity in Ford relative to what the options think. And then again, the GDX, there's GDX with the 71 scorecard. So again, the options we think are priced probably not correct, so to speak, and there's a lot of volatility that can come. And again, when you have a low scorecard, like Google, for instance, is pretty low, that doesn't necessarily mean it's bad, so to speak. There are various strategies you can do to make money when stocks simply do not move, some butterflies or some credit spreads or put sells when things don't move, and that's kind of the way we've been using our scorecard when we have low scorecards. Now, where do we go from here? I'm about to wrap up here. I've been talking about 45 minutes or so. Where do we go from here? The past 10 years, really, we are at virtually no gains. And you can see on a longer-term chart, that's kind of rare. And when you have no gains over 10 years, and again, it makes sense because a lot of people are fed up with this market. Yes, we've had a good rally the last few years, but still, overall, big picture at Schaefer's, we still don't think we're anywhere near, as I showed that chart earlier, euphoria, so to speak. And there has never been a peak in the stock market without euphoria. People throwing money at the market, and that's simply not here yet. Now, again, the closest thing to euphoria is the metals world, gold and silver. It's not there yet, we don't think, and everyone says we just need one more bubble because you want to trade one more bubble, and commodities very well could be quote unquote the next bubble. Nonetheless, that doesn't mean it's bad. There could be a lot of money still that can come into commodities and push the group just that much higher. But specifically, from a longer-term point of view, we still think stocks make a very, very nice, or at least U.S. stocks make a very nice longer-term buy here. And then looking at consumer confidence is still very low. Here's a neat chart that shows that. You can see when consumer confidence has been as low as it was recently in the early 80s and the early 90s. Both those times were pretty good times to be accumulating accumulating stocks. And last month actually was one of the largest drops in I know the recent consumer confidence numbers came out today, but last month they were one of the largest drops we've seen since the bull market started, and it makes sense with all the negativity in mid-March with Japan and the Middle East. Nonetheless, historically low consumer confidence from a contrary point of view is actually very positive for the overall stock market. So that could be a very good sign from that contrarian point of view, from a longer-term point of view. Reasons to be optimistic. Reasons to be optimistic. What a difference 23 years makes. The movie Wall Street came out right before the crash in '87, and it had kind of what we like to call Masters of the Universe feel to it. Wall Street, it was neat to be on Wall Street. It's fun to be on Wall Street. You can make a lot of money. And then fast forward 23 years to the recent Wall Street movie that just came out last year. It didn't have that same feel to it. It was kind of noting how a lot of the hedge funds were at fault for what happened during the crisis, and it isn't so glamorous to work on Wall Street. But again, from that contrarian point of view, the first Wall Street marked it marked a short-term peak right before the '87 crash, and the recent Wall Street had that negativity to it, which we think can be really positive from a longer-term point of view. Lastly, I will leave you with this quote by Humphrey Neal. The crowd is most enthusiastic and optimistic when it should be cautious and prudent, and is most fearful when it should be bold. And again, thank you very much for listening. I apologize for what seem to be some pretty significant audio issues. Nonetheless, I think it's time for questions. Thank you very much.
Hi, Ryan. People have been asking questions as we went along, so I've logged them, and I'm going to go ahead and send them over to you, and everyone else should just feel free to type more questions into the chat box as we go through them.
Okay.
I'll send them over to you now.
Okay, yeah, looks like there's lots of good questions here. I'll just kind of go through the list here that I see. One of them is how you measure expectations, and that's the question. How do you measure? That is a very good question, and that's tough. I'll be honest. I mean, there's an art form to it, and as we talked about here, it's sometimes you're never going to be always right. But I think it makes sense when it comes to expectations to make those broader, bigger term picture outlooks on overall things, such as the overall market or the overall opinion on various sectors or ETFs. In the short term, though, you can make those short-term fades. Like I said, if there's a bullish magazine cover out there coupled with some optimism that you hear on TV or some of the analysts saying things, that can mean there's a little over-the-top optimism. So it's very tough to measure expectations in the near term, but bigger picture, I think that's where we can make more of our money on longer-term trends with expectations. Let's see here. In looking at put-to-call ratios, what do you think is favorable for purchase? Hopefully I'm going to answer this correctly. I'm not exactly sure what they're getting at, but what we look for with put-to-call ratios is not like an overall number, so to speak, put-to-call ratio of 2, meaning 2 times as many puts as calls. What we like to do as Schaefer's, and this is actually free on our website, is we look at put-to-call ratios relative to where they are over the past year. I think this is probably a better way to do that. When you see a put-to-call ratio that's in the 100th percentile over the past year, that tells you there's a lot of skepticism coming in. I know I mentioned Boeing, actually. They have earnings tomorrow. Their put-to-call ratio is coming in currently at the 9th percentile, meaning that ratio is lower than 91% of the readings over the past year. So that tells you there's some good amount of optimism in the options market before earnings. So again, that's not necessarily a quote-unquote bearish indicator, but it is something to be considering of, or that a lot of people are expecting higher prices. So that's kind of how we tend to use put-to-call ratios. There's one question on how to check short interest on an ETF. And again, this is something that we actually do have on our website, but I'm pretty sure when it comes to short interest trends and things like that, you can get most short interest data simply from using like Google Finance or Yahoo Finance. One question is, what settings on the monthly MACD do I use? And I just use the standard settings, which are 12, 9, 26. But again, if you go like to stockcharts.com, which is a really nice charting software, and it's free, I just use the standard MACD charting. And when it comes like to RSIs, and I look at RSIs, I'll use a 14-unit RSI. Again, just standard ones I know other people are looking at, but I don't get too into the indicators. I like to use price action more so, but the standard MACD histogram and the standard RSIs are what I tend to use. See here. Well, actually, let's see. There's one final one that says, how do you put sentiment into a quantitative number to tell me when and how much a financial instrument will make a move? And again, that's the art form. That's very tough. So that's kind of where I think where we think at least our volatility scorecard. First off, I don't know if anyone can do that, unfortunately. But the volatility scorecard is a neat way we think that can tell you potentially how much volatility is priced in the options or is priced into the shares, but maybe not priced in the options. You can have that volatility and potentially profit from it in the near term. But again, the bottom line is when it comes to trading, we're big into following the chart and just looking for bigger term trends that are going contrary to the overall sentiment. Again, small caps have been strong. We still think commercial real estate looks good to us. Housing is an interesting one because various people hate housing for a lot of good reasons. Again, you can't argue with a lot of the fundamental reasons not to like to dislike housing. Nonetheless, look at the XHB, the housing ETF. It's held its own. Now, it's not really outperforming, but it's held its own amongst a lot of negativity. So that could be a neat contrary play on the longer-term trend also. That's an area we like. I'm trying to think what else. One we do not like currently would be financials here. If you look at financials, the XLF specifically, it's underperformed recently, yet we've seen a lot of optimism. If you look at Bank of America, if you look at Citigroup, if you look at JP Morgan, kind of some weak price action compared to a lot of other areas out there. Nonetheless, a lot of optimistic sentiment coming in from the media and a lot of calls coming in. Analysts continue to defend these shares. Now, we're not expecting a crash like we saw in '08 with financials leading the way down, but to us, should the market, pull back here, which it will eventually, financials could be an area we would fully expect to probably continue to underperform here. I think those are most of the questions. We've been going for almost 50 minutes or so, 55 minutes. So unless there's any other questions, I don't think I have really too much more to add to, I don't think.
All right. Well, thank you, Ryan, so much for participating today. And I just wanted to thank everybody else as well and apologize again for the audio issues we had today. It's not the norm. We just ran into some issues today, and we hope that you'll join us again soon for upcoming webinars. Just to give you a quick look at some of the resources that ISE has available on our website regarding ETFs and also indexes. For more information about ISE index products as well as ETFs that are based on ISE indexes, you can visit our site at ise.com/ETF or ise.com/index for all of that information. You can also sign up for free ETF trade alerts on our website at ise.com/ETF trade alerts. You can listen to this presentation as well as all of our past webinar presentations as podcasts. You can get those at ise.com/podcasts. You can also visit our webinar section of our website to sign up for future webinars as well as view our archived webinars. This webinar will be up within the next few days, and you can view that at ise.com/webinars or ise.com/archives. A lot of you have asked if this will be available. So again, yes, within the next few days we'll have this up and archived on our site at ise.com/archives, and it'll also be available as a podcast at some point in the next week. So unless there are any other questions, we'll just go ahead and say thanks again to Ryan and thanks to everybody else for joining us. And we hope to see you again soon. Thank you.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.